Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Kennametal Inc. quarterly report. Kennametal Inc. offers a diverse range of businesses and services across two primary segments, metal cutting and infrastructure. The metal cutting segment provides various solutions for manufacturing industries, including milling, hole making, turning, threading, and tool-making systems under the Kennametal, WIDIA, WIDIA Haneda, and WIDIA GTD brands. These products cater to a wide range of sectors such as airframes, aerospace engines, trucks, automobiles, ships, and industrial equipment. In contrast, the infrastructure segment focuses on producing engineered materials and components for various industries. This includes tungsten carbide and ceramic components used in oil and gas, petrochemicals, general industries, underground mining, trenching, foundation drilling, and road milling. Additionally, Kennametal offers high-temperature critical wear components, tungsten penetrators, armor solutions for aerospace and defense, and ceramics for the packaging industry. The company's products are distributed through a direct sales force, network of independent and national distributors, integrated supplier channels, and digital platforms. With a rich history dating back to 1938, Kennametal has established itself as a leading provider of materials and solutions across multiple industries worldwide. Unfortunately, I do not have access to the text you provided. However, I can still provide a general overview essay on what might cause a stock price to skyrocket. The stock price of a company like Kennametal Inc. can skyrocket due to various factors that demonstrate its growth potential and financial health. One key reason is a significant increase in revenue or earnings per share, which indicates the company's ability to generate profits and expand its market share. This can be driven by innovative products, strategic acquisitions, or successful expansion into new markets. Another factor contributing to a surge in stock price is a strong industry trend or demand for the company's products. If Kennametal Inc. specializes in manufacturing tools or equipment that are essential for various industries, such as aerospace or automotive, and there is a growing demand for these products, its stock price may rise accordingly. Additionally, a change in leadership or management strategy can also impact the stock price positively. If the company's new CEO has a proven track record of success or implements innovative strategies to drive growth, investors may become more optimistic about the company's future prospects. Furthermore, external factors such as economic growth, government policies, or technological advancements can also contribute to an increase in stock price. For instance, if there is a growing demand for Kennametal Inc.'s products due to increased infrastructure spending or government initiatives, its stock price may rise accordingly. Lastly, investor sentiment and market trends can also play a significant role in determining the stock price of a company like Kennametal Inc. If investors become more optimistic about the company's prospects, or if there is a broader trend towards investing in industrial or manufacturing companies, the stock price may surge as a result. Kennametal Inc. market capitalization of $3 billion is materially smaller than most of its industry peers of roughly $9 billion. Kennametal Inc. trades at a higher price-to-earnings ratio of 32 times and a lower price-to-book ratio of 2.21 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that investors are already valuing the industry with a forward premium for the industry, leaving limited opportunity to uncover undervalued stocks. The company maintains a moderate leverage profile, with liabilities making up 48% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The company has consistently reduced its share count, reflecting a shareholder-friendly approach to capital allocation. The company have a dividend yield of 2.09%. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be identified through a review of the extracted summaries. On the revenue growth side, several factors contributed to the increase in sales and gross profit for both 3 months and 6 months ended December 31, 2025. The metal cutting segment saw a $33.7 million increase in revenue, 11.2% growth, while the infrastructure segment experienced a $14.2 million increase in revenue, 7.7% growth. Organic sales growth was also a significant factor, with a 10% increase for both 3 months and 6 months. In addition to organic sales growth, favorable currency exchange effects and pricing compared to raw material costs within specific segments also contributed to revenue growth. For instance, the infrastructure segment benefited from a $25 million favorable timing of pricing compared to raw material costs. Similarly, the metal cutting segment saw incremental year-over-year restructuring savings and higher sales and production volumes. On the other hand, revenue decline was observed in certain regions and end markets. The infrastructure segment experienced a decline in revenue in EMEA and Americas regions, while energy end market sales decreased in these same regions. However, it's worth noting that some segments and regions still saw growth, such as the metal cutting segment in Asia-Pacific and the aerospace and defense end market globally. Overall, the primary drivers of revenue growth or decline can be attributed to a combination of factors, including organic sales growth, favorable currency exchange effects, pricing compared to raw material costs, and regional and end market specific trends. The net income of the company has experienced significant growth over the past 2 years. In 2025, the net income increased by 26% compared to 2024, reaching $149.8 million. This increase is attributed to favorable market conditions, including higher sales and production volumes in the metal cutting segment. The segment's operating margin saw a substantial jump of 82.3%, from 67.3% to 122.6%. In contrast, the profit margins have shown mixed results. The gross profit margin decreased by 2.8 percentage points over the 3 months ended period, and by 0.8 percentage points over the 6 months ended period. However, the operating expense as a percentage of sales remained relatively stable, increasing only slightly from 21.9% to 22.3%. This suggests that while the company's revenue growth is driving net income increases, its profit margins are not expanding at the same rate. The metal cutting segment's performance was a key driver of the company's overall growth. The segment's higher sales and production volumes led to increased operating margins, contributing significantly to the company's net income increase. Additionally, the favorable timing of pricing compared to raw material costs and the implementation of pricing and tariff surcharges also played a role in the company's improved financial performance. The company's financial performance is a testament to its ability to generate consistent and positive operating cash flows. For the 6 months ended December 31, 2025, the company reported an operating cash flow of $72,606, demonstrating a strong foundation for future growth. This trend continued in the previous period, with the company generating $100,900 in operating cash flow for the 6 months ended December 31, 2024. The consistent generation of positive operating cash flows is a significant indicator of the company's financial health and stability. And the company's debt level and interest expenses have undergone some changes over the past year. According to the extracted summaries, long-term debt has increased by $4,404 from $592,788 to $597,192 as of page 4. However, on page 12, it is reported that long-term debt decreased slightly from $570.8 million to $576.7 million in fair market value by December 31, 2025. The total debt remained unchanged at $598.6 million. Regarding interest expenses, the summaries suggest a decrease or no significant change. For instance, on page 3 and page 20, it is stated that interest expense decreased from $12,493 to $12,275 for the 6 months ended December 2025. Similarly, on page 24, it is reported that interest expense decreased by $0.2 million for the 6 months ended December 31, 2025. However, there are conflicting information on interest expenses between different pages, with one instance showing an increase in 3 months ended December 2025. Despite this discrepancy, the majority of summaries suggest a decrease or no significant change in interest expenses. Management is optimistic about the company's financial prospects. The implementation of commercial excellence and operational excellence initiatives aims to achieve key goals in liquidity, capital resources, and financial position. These efforts are expected to yield benefits from restructuring, simplification, and modernization. The company boasts a strong liquidity position, with significant cash flow generated by operating activities and additional availability under the credit agreement. Management is confident that they have sufficient resources to meet their cash requirements for the next 12 months. Furthermore, they remain committed to their share repurchase program, having already repurchased $70 million in common stock. Management will continue to closely monitor the company's liquidity position and the capital markets, ensuring that they are well positioned to navigate any future challenges. Overall, the outlook is positive, with a focus on driving growth through strategic initiatives while maintaining a strong financial foundation. The company's financial performance is influenced by various acquisitions and divestitures. Notably, there are no recorded acquisitions throughout the report. However, several divestitures have been mentioned as having an impact on the company's sales growth. A 1% divestiture effect was observed in 2 instances, page 22 and page 23. Furthermore, a more significant divestiture effect of -4% was noted for the 3 months ended December 31, 2025. Additionally, a divestiture had a positive impact on infrastructure sales, increasing it by 4%. The effects of divestitures were also observed in specific end markets. For instance, there was an effect on general engineering end market sales in EMEA and energy end market sales in the Americas. These divestitures demonstrate the company's efforts to restructure its operations and optimize its performance. The company has a history of rewarding its shareholders through various means. One way it has done this is by paying dividends, which is a clear indication that the company values its investors and wants to share some of its profits with them. This practice is evident in multiple sections of the report, specifically on pages 23, 29, and 30. In addition to paying dividends, the company has also been actively buying back shares from the market. This strategy allows the company to reduce the number of outstanding shares, thereby increasing the value of each share for existing shareholders. The company's buyback activities are documented in several sections of the report, including pages 5, 14, 15, 23, 29, and 30. That concludes the financial summary for Kennametal Inc. Feel free to comment below, and I will be happy to answer them when possible.